Um, and if you just take a look at the numbers, it might be hard to see from that screen there, but it's on the handout. In terms of currency depreciation and in terms of the stock market movements, Korea is very much up there among the major emerging market countries in Asia, and also certainly in terms of the sovereign CDS, the widening has been along the lines of the other countries. Of course, Korea has very low public debt, and that's one of the things to keep in mind. That in terms of that might also explain that, unlike in the stock market or the currency, the sovereign CDS that hasn't moved at the top end of Asian countries. Coming back to the FX market, given that the domestic market is fairly liquid, you do see transactions going through the FX market, and that's showing up in some of the pressures. This shows you a little bit about how the basis swap spread I just talked about and where it is, but you have to look at it in terms of also the range that it moved overall over the past several years, since in 2008 2009 was the comparator period. So again, we are not anywhere near the move that we had seen in 2008, and there are several things that are different from then. Besides, I mean, obviously we haven't had a Lehman-style liquidity squeeze so far. But the fundamentals are a lot better in many ways. The authorities have put in measures to reduce the short-term foreign exchange debt of the banks, and including through measures such as limiting the amount of forward contracts that can be given out so that people wouldn't overhedge, which caused the big run-up in short-term bank debt, which was a big concern back then. In addition, liquidity requirements have been put in long-term assets versus long-term liabilities, and a host of other measures. And recently, even a bank levy, macroprudential stability levy, has been introduced to discourage short-term bank debt inflows. So, and capital adequacy now over 14%, about 14.3, I believe, and that's higher than what it was back in 2008. So the fundamentals are stronger. That being said, it's a fact that when a liquidity shock hits, and we are having some stresses on liquidity globally, and you're seeing that obviously market moves everywhere, then the most liquid markets tend to get hit the most. As there's a demand for liquidity, and you often you get money or cash. Investors get money, and banks too. Besides portfolio investors get cash out of the markets they can, not necessarily the ones they want. And that's a little bit of what you're seeing right now in terms of the moves in the market. As I said, this is not 2008. Things are different. Loan-to-deposit ratios, which were identified as a key vulnerability given the large amount of wholesale financing by the banks. And remember, wholesale financing, banks tapping markets for funding, those are the things that dry up when there's a demand for liquidity. Regulations were introduced to bring that below 100%, and they've been effective in sharply reducing the loan-to-deposit ratio. And as I said, non-performing loan ratios will remain relatively moderate, and the capital adequacy ratio now is much higher than back in 2008. So the Korean authorities have been very active since 2008 and incorporating the lessons of that and moving very quickly to make sure that there's not a repeat of that kind of external shock affecting the local economy. Even then, the policy response was strong. It prevented a big deleveraging in the domestic economy. And Korea's growth when many countries had negative growth in 2009, Korea still registered a very small positive growth, and then, of course, had a huge recovery in 2010 and closed the output gap. And so this output is now where it should be relative to pre-crisis levels. So we also see Korean banks don't have any funding problems so far, and they are able to roll over their short-term debt, and in fact, they're able to acquire foreign exchange liquidity without any problems. There's generalized tightness in funding, obviously, globally. But again, there's nothing specific about Korean banks here. And There are another thing you may have seen in the news this year actually is on the mutual savings banks, which have been going through a due diligence process and restructuring, and questions about the bank's exposures to small and medium enterprises, particularly in the construction-related sector. I think it's important to keep in mind the mutual savings banks problem has been around for over 10 years. In fact, it was identified as an issue in IMF FSAP, what we call the Financial Sector Assessment Program, back in 2003. But the mutual savings banks are a very small part of the banking system. Their assets are less than 5%, and the authorities have put in a process and they've moved forward with it in terms of due diligence, and deposits to a certain to that limit are guaranteed. So the problem is well contained and is being handled. And as I said, it's an insignificant part of the banking system. It tends to get headlines because everybody loves a good story about banking problems, but unfortunately for them, Korea is not the place to look for a story like that. Coming to the bottom line on this, we think a balance of payments crisis is unlikely, even if things were to go south even more in global markets. They have a comprehensive policy toolkit in place. A lot of the measures that were put in place to prevent the massive deleveraging back then. It really helps to have policy space, low public debt. There is fiscal room as well to cushion the downturn, and it's really, if you look even at fiscal policy after the big stimulus in 2009, once the economy was on the path to recovery, fiscal policy went quickly back to consolidation in 2010 as the handover took place from public sector driven growth to private sector growth. In addition, Korea has large reserves, about 303 billion or so by the latest read, which is more than twice the level of short-term debt. And then financial markets are well developed, so you can activate things like repo lines and provide liquidity even domestically. So far, the response of authorities has been to keep monetary policy on hold since June, and also to maintain public confidence by pointing out these fundamentals and pointing out that there are adequate reserves, the banking system is healthy. Because, as you well know, in times like these, sometimes rumors get started or perceptions feed. I mean, you just need to look at the US stock market. One day people are really giddy about, there's a resolution in Europe happening, which was last hour of trading yesterday when the market went up about 4%. But the day before yesterday was the opposite, all doom and gloom. So it's important to be clear on what the facts are and to help guide perception so that people are, not just, in an echo chamber and listening to what everybody else is saying and buying and selling. So, as I said, there's also room for fiscal stimulus if needed, given low public debt, and also policy rates can be cut. In our report, we've been talking about the pressures of overheating in the Korean economy. Inflation has been above the target band for 9 consecutive months, and so our policy recommendation was to continue the pace of monetary tightening. In the baseline, that still remains, in our view, the right advice, but clearly conditions have changed, and so it's appropriate to stay on hold and see how things go, and then let monetary policy react, and if necessary, even cut rates. There's room to do that. There are, of course, risks, and they are tilted to the downside for the Korean economy. One is, of course, the worsening outlook for the advanced economies and for escalation of stress in the euro area. Worsening of the outlook could mean a more protracted downturn or a really slow recovery, both in Western Europe and in the US. And we also have to think of a scenario where there could be a severe escalation of financial stresses, and that could have an impact on interbank funding channels for Korea as well. Geopolitical risks from North Korea always remain a risk, and we always try to follow that as closely because that's a big unknown, hard to quantify, but certainly not something we can ignore. On the domestic side, there are some other risks to the outlook as well. The inflation rising over the last year, and especially all through 2011, means disposable income is lower, and that could have a dampening effect on consumption. And the way we look at it is, the trade-off between growth and inflation, the Phillips curve, does not operate permanently. So at some point, you could end up with a situation of slightly lower growth and higher inflation. So that's a risk. And I mentioned the troubled construction and real estate sector, and obviously that sector will need to be dealt with, and it is being dealt with, but take some time, and involves both the mutual savings banks and the construction sector itself, which has grown quite rapidly and now needs to shrink. So that could also be a downside risk to the outlook. So the underlying fundamentals being as they are and robust, we are projecting growth of 4% in Korea, which is around potential for this year. And given strong domestic demand, picking up to 4.4% next year. Of course, this is being supported by accommodative monetary conditions with a policy rate at 3.25%. Real interest rates are negative right now. Market conditions are easy, and then we've had a big depreciation of the exchange rate more recently, which also eases monetary conditions further. We would expect in the baseline that things will recover in the advanced economies and will help exports. Of course, Korea's exports are highly diversified across markets, including emerging markets, and depending on the measure you use, that ranges anywhere between 55 and 70% of total exports. So that should provide some lift, particularly given the outlook for Asia remains generally promising and more promising certainly than the advanced economies. And also capacity utilization is near all-time highs. So eventually, when the uncertainty resolves, capacity will have to be added to the investment and employment as well. Although labor markets are already in very good shape and employment is back to pre-crisis levels, but it will support incomes. That being said, there are risks to the downside, more so than perhaps at the time that our report was published. And so, overall, we think that the near-term challenges do remain relevant. Bringing inflation back within the targets will be important going forward. And that's, you can see that this has been updated with most recent data on the chart, but not in the handout. The inflation is still above the 3 plus minus 1% band, and core inflation still remains quite high, close to the top end of the band. And some of the rise in inflation has been due to food and fuel price rises earlier in the year and late last year, and in many other countries as well, especially in Asia. But also in terms of the monetary conditions that I talked about earlier, which have been highly accommodative for quite an extended period of time. Just coming back to the outlook, so we do think that, assuming that things settle down in terms of uncertainty, the domestic demand should rebound more strongly next year, making up for some of the moderation that we are likely to see this year, especially in the second half of the year. Fiscal policy is broadly neutral this year, and we think it is appropriate. There's no real need to do more at this stage. As I said, the output gap is closed, and the growth at around 4% that is at potential. And so there's no need to do anything on the fiscal front to stimulate growth at this juncture. Monetary policy tightening should continue, but obviously needs to be more attuned to developments in global markets and in terms of being able to provide liquidity to the domestic financial system. So in our baseline, we still have a projection of a modest increase in interest rates this year, and additionally more next year to bring it closer to neutral. This would also help the household indebtedness problem, another thing that has been in the news quite a bit in Korea, and the authorities have reacted with a comprehensive set of measures to deal with that. Loose monetary conditions and negative real interest rates incentivize households to obtain credit, especially from non-bank financial institutions, and which can be a more expensive source of credit. Now, the household debt issue has been rising. Household debt has been rising for a long time. It didn't happen overnight, and it's certainly not due to the monetary policy stance, but monetary policy normalization would help in at least at the margin to reduce incentive to borrow more. I'd like to turn briefly now to the medium-term challenges, the key ones for the Korean economy. As you know, our view being the Korea being such an open economy, both through trade and financial channels, means that it is subject to shocks globally, and shocks, the financial and trade shocks do affect the Korean economy. So the resilience of the Korean economy is a key medium-term policy priority, to make sure that even when shocks hit, the economy can weather them relatively well without a big impact on output and employment and inflation or financial stability. So in terms of that, we have two components that we focus on in the report. One is on what we call the macro-financial framework, which is we're taking a more integrated view, not just thinking of macroeconomic framework, which is monetary policy, fiscal policy, and exchange rates, but given the large role of the financial sector in Korea and elsewhere, we have to look at it comprehensively, including through the role of the financial sector and what it does. So we call that a macro-financial framework, which is macroeconomic plus financial framework, because it is relevant for the stability of the financial system, but also for the economy. The other thing is, of course, rebalancing the economy. Between Korea is a highly export-oriented economy, and so you can be more resilient if it relied less on just on exports as an engine of growth. The main objectives of this macro-financial framework are to keep growth stable and equitable, and to keep inflation low within the Bank of Korea's target of 3 plus minus 1%, and to financial stability. And this can be done, in our view. This needs to be done partly because you see the volatility in the Korean economy, especially at times like these, do show up in markets and in a premium. And people talk about the Korea premium quite often, and it may be contributing to a higher cost of capital. So reducing volatility by making the economy more resilient would also help improve further long-term growth prospects. Now, in terms of how do you achieve this, and how do you get to the objective for the macro-financial framework we have in mind, what we think is, one is financial stability could be paid more attention in monetary policy and inflation targeting framework. You know, the view has been the orthodox view that inflation targeting is just about inflation, and then macroprudential policies can deal with everything else. I think we have sufficient evidence by now from the crisis and including the housing issue in the US that things are interlinked, and monetary policy affects asset prices and affects how our financial sector behaves, and macroprudential policy, of course, their settings affect the monetary transmission mechanism. So we do think that price stability, of course, should remain the primary objective of monetary policy in the Bank of Korea, but making the interest rate policy more sensitive to systemic financial stability considerations would help prevent the buildup of excess leverage and risk-taking, and could help at least signal that asset prices may be moving and banks are reacting. And certain central banks already do that. For instance, Sweden, they quite sometimes say we raise rates because we're worried about X and Y. And eventually everything translates into macroeconomic volatility, so they're not incompatible. The Bank of Korea Act was recently revised, in fact, to incorporate financial stability as a major component, and we are still waiting to see the details of how that will actually be implemented. But we are very pleased to see that after a lengthy debate going at least 2 years, financial stability, the National Assembly has added financial stability to the Bank of Korea's objectives. The other thing is the consistent use of macroprudential policies. Now, macroprudential policies are almost talked about as the holy grail of financial stability. But the thing is, they have to be applied consistently with the macroeconomic policies and with each other. Otherwise, there is a danger of becoming too trying to have targeted instruments for everything and saying, okay, let's apply a macroprudential policy here to deal with capital flows, let's do another one to deal with house prices, and you can end up with an inconsistent policy mix. And so, a simple example, not for Korea, but in general, would be, for instance, if you have loose monetary policy and then are trying to tighten the screws on certain asset markets, it may not work. Similarly, on exchange rates, macroprudential policies to prevent inflows will not be that effective as long as there is a compelling one-way bet on the exchange rate. So they have to be applied together. The third thing in that component is the fiscal framework. Korea is a rapidly aging society, and the burden of an aging population is likely to be felt over coming decades. And so the fiscal framework, the medium-term and long-term fiscal framework, if it was formalized, taking into account longer-term liabilities and contingent liabilities, that would help couch short-term fiscal policies more in a longer-term budget framework. And that would also help reduce volatility and maintain adequate fiscal space for when times are difficult. I'll go somewhat quickly over the next few slides because I've already talked about them verbally. The first was, as I said, on financial stability in the inflation targeting framework. And one of them could be just to actively monitor financial stability indicators and react with appropriate interest rate adjustments as necessary. And as I mentioned, the BOK law was recently amended to give the Bank of Korea more of a role. On the consistent use of macroprudential policies, an interesting example that comes to mind is with regard to things you may have heard about in other countries, which is debt-to-income and loan-to-value limits for mortgages. And they were first introduced for financial stability reasons and to also prevent overborrowing by households for housing purposes. But what we have seen, and we talk about that in the report, they've been adjusted in Korea quite frequently to manage generally, or at least the outcome has been to manage house prices relatively tightly. And despite we see high levels of household debt right now, and given that and the aging of the population, house prices need to be able to adjust both up and down. And managing them can create expectations that house prices will never fall. And so in some sense, the LTV, DTI limits and other measures can manage house prices, but they can end up leading to having an impact on household indebtedness, because if you think house prices will continue to rise, then you will continue to borrow. So that's why the consistency of policies, and you need to think of the unintended consequences of a targeted policy in one sector, which is, in this case, for example, on house prices, what it will do for the overall economy. This is a chart taken from the staff report, which is, if you look at if prices are managed this way, they do create an expectation of continuous house price appreciation, because as you can see, nationwide house prices have never really fallen in at least the last decade or so. And so so there's always an incentive, because you can then cash out and get a bigger loan and in a way refinance your 3 or 4 year bullet mortgage with a bigger one. So even if you put down a hefty payment, you can still borrow more and increase your leverage that way. It's a way of extracting equity. Korea's fiscal prudence, of course, has been very impressive, especially among the OECD countries and advanced economies. Its public debt is very low, and of course the plan to balance the budget by 2013-2014 is welcome. But as I mentioned, linking targets to future liabilities through a structural rule would help ensure that the fiscal objectives are consistent with the changing demographics, long-term sustainability. And so details on policies need to be spelled out to achieve medium-term targets, and they should be linked then to annual budgets. That's our view on the long term. And there can be revenue measures as well taken to broaden the tax base to make sure that the economy is well positioned for the aging of the population. There are also contingent liabilities such as from state-owned enterprises, and those need to be also over the long term addressed, and they can be so making them operate on a more commercial basis. The last point is on rebalancing the economy. We've talked about this several times in the fund in many countries. Korea is, of course, highly export dependent and makes the economy vulnerable to shocks. We also think it has contributed to rising inequality because those who are employed in the manufacturing and export sector tend to benefit, while those who are in the non-tradable sector, their incomes tend to rise much less. And most of the people that are employed, in fact, in the non-tradable sector. So, with the terms of trade being as they are, and in terms of the bifurcation of household incomes, this reliance on exports can exacerbate income inequality. So, what it needs is to increase the productivity of the non-tradable, to require exchange rate flexibility, more exchange rate flexibility, opening the services sector to more competition, eliminating the preferential treatment of the manufacturing sector in several different ways, and concluding the restructuring of the small and medium enterprises, and a move towards also fixed rate mortgages. We think would be helpful medium term to reduce the vulnerability of the economy to shocks. That concludes my presentation. So maybe happy to take questions or after any.
Thank you, Subir. And I would be remiss, there's one thing I forgot to mention about Subir Lall. We've also been fortunate over the last few years for Subir to contribute an article assessing Korea's economy in our flagship publication, Korea's Economy. So if you don't have a copy, his most recent article on that is in here as well. So please try to on the way out. I will turn it over to Danny.
Okay, thanks. I think I'll forego the PowerPoint that you have in your handouts because I'll just get a step back by turning too quickly. But I think apart from Subir and I having gone to the same graduate school, there are also some other strongly symbiotic relationships going on here. One is that what I'm going to talk to you about is based on a paper that I did with co-author Elena Anchovicina, I always have trouble, who used to work at the World Bank and now is at the IMF. And finally, Subir has gone through the short-term, medium-term, and I'm going to talk about the long-term. So it's not based on the concordat between the bank and fund, but just by the virtue of what we've been working on. So basically, as you know, the Lee Myung-bak administration had very lofty expectations when it came in that they would be able to restore growth to something similar to the past, that they could get to 7%, that they could get to $40,000 per capita in a reasonable period of time, and that they would be the seventh largest economy. And so in Korean tradition, this was the 747 plan. We have to give him a pass because he didn't anticipate the global downturn. But even if the global downturn hadn't occurred, the first slide that you'll see shows the IMF's calculations of a few years back on potential growth rates for Korea. And they don't change monthly, so they're still relevant. And essentially it shows Korea going down to a potential growth rate of about 2.5% within a decade or so. So clearly this is at odds with at least what the administration wanted. And the question that we tried to look at is what's really driving this reduction in the potential growth rate. And it comes down to a couple of factors. One already mentioned, which is productivity in the service sector is pretty weak, actually, in Korea. And secondly, there are a bunch of demographic labor market issues. So what we tried to do was see what would you need to do to get Korea anywhere close to a higher long-term potential growth rate. So if you start with productivity, just a few factoids. Between 1982 and 2002, productivity in the service sector was half of what it was in manufacturing. It was about 50% of what it is in the U.S. And 70% of what it was in Japan. And a number of subsectors had negative TFP growth in the 80s and 90s. So the export sector doing really well, but the non-tradables not doing so well. And the question there is, what can be done to improve labor productivity? It's not preordained. There are some countries, Australia is a good example, that did a number of reforms in the 80s and 90s to improve productivity across the board, including in non-tradables. So in the handout, there are a few suggestions. I think Subir has a few that are sort of that are consistent. Basically, you need to improve competition and ease regulation, land regulations, and others that are impeding productivity in the non-export sector. So we do a calculation. So the next graph that you'll see is a hypothetical. All the graphs are in that what if kind of category. So what if you could bring Korean productivity in the service sector up to what it is in manufacturing? Now that's a big if. Okay, it's not going to happen, but it gives you the maximum bang for your buck that you could get out of that kind of change. And it turns out that in the long term, which is up till 2050, you could get on average a 1.2% increase in growth every year. It's weighted towards the early years, as you'll see in the graph, and it does come down over time. But it gives you a sense that there's at least a percentage point of growth available were the Koreans able to do something about their weak productivity sector and a sector that in most economies as you grow is going to increase in importance and not decrease. Secondly, let's look at the labor market. Korea's population is aging rapidly. You're glad to see a lot of young people around the table because they're going to have to take care of their elderly parents and relatives. And the birth rate is among the lowest in the world. Okay, and so the question is, what can you do about it? In the shorter term, you can change labor force participation. I'll talk about that. You can deal with early retirement, which is excessively generous, if you want to put it that way, in Korea. And you can try to do some things for the longer term. So the bar graph that you see shows Korea's female labor force participation rates compared to U.S., OECD, and Japan. Well, we expect them to be low compared to the U.S. They are the lowest in the OECD, but amazingly, they're lower than Japan. So there's something going on in the labor market, particularly in a gender context, that is not doing Korea any favors. Okay. If one wanted to address that problem, there are some issues having to do with child care. We give some suggestions of what other countries have done. Korea spends less on child care than any country in the OECD. And it's just not a thing that culturally or in terms of access to child care is moving in the right direction in Korea. The next chart from the OECD shows part-time work for women aged 25 to 54. There are only two countries that are single-digit. Finland is there for different reasons. They have different types of work-sharing arrangements, so the fact that they're low on part-time work is not giving you the right story. But Korea is the lowest on this chart. Okay, so part-time flexible work arrangements are difficult to find. The only country that I've seen that is similarly rigid is Chile, which by coincidence, or not by coincidence, but also has the lowest female labor force participation rate in Latin America, 10% below Brazil, Argentina, Uruguay, etc. So there's some similarity there in terms of impediments in the labor market. Other things to look at, it's a bigger topic, but I think there's a lack of female role models in the corporate sector in Korea. I think that's pretty clear. I think there are a lot of reasons why Korean women are not commanding the salaries of male counterparts, and I think if you brought the heads of the top 100 corporations of Korea into the room, I don't think you'd find too many women. On the retirement age, it's well known that private sector tends to retire at 55, government sector at 60. There are a lot of people above that age that would like to continue to work. And given what's happening to the population growth rate, I think Korean incentives are not in the right direction. They're not encouraging women into the labor force. They're not encouraging people to work longer. Yet, the demographics are there. Among the social sciences, demographics are the most predictable statistics, except for wars and disease. You pretty much know what your population is going to be. So, the handwriting is on the wall. So we, in the next graph, try to fiddle with the labor market and make a pretty modest assumption that female labor force participation rates are set to those of Japan, not a lofty goal, and that male participation rates go to the OECD average. And you get about a half percentage point of increase in potential growth. So if you put these two together, you're talking about at least 1.5% to 2% increase in potential growth rate. If you really want to get up to the lofty goals of the administration, you'd have to do something in terms of long-term population growth. Okay. If you don't do anything on the short term, you may as well forget about the long term. But were you to be able to intervene with some policy changes in the short to medium term, and also you could get Korea's population growth rate to the OECD average, which is not great, right? You could also add another potential point to potential growth in the longer term. This is like 20, 30, 40, 50. So the last chart basically says that you could get to a doubling of income by 2020 if you did all of these things. This is obviously unrealistic in the sense that Korea is not going to be able to do all of these things. But it gives you, or a Korean policymaker, a pretty good picture, right? You want to be at 2.5, or you want to be at 5 in the long term. You're going to be at 2.5, forgetting about short-term fluctuations. Given your low productivity, your early retirement age, your, I would say, discrimination against women, which doesn't help in the labor market, and your low population growth rate. And so some of those things are amenable to change over this longer period of time. So anyway, it's sort of a heuristic exercise to show Korean policymakers that not everything is preordained. On the other hand, if you do nothing, it is.
Thank you. Well, we've had two very detailed, interesting presentations, and at that, I'd like to open up the discussion. Yeah, Dr. Chun.
I'd like to go back to the Dennis points on the labor supply, the declining labor supply, and some restrictions to that. You mentioned that I fully agree with you on those. We need to increase the female labor participation. But in the long term, actually, the problem is the very lowest wage rate. And raising female labor participation may end up actually much lower birth rate. And to me, the reasons why the birth rate is very low is in part due to the very high cost of the raising kids. The education cost, the private spending is very high in Korea, and they actually take those things into account when they decide whether to have a child or not. So probably there should be some kind of reform to the education system and the expenditure sharing, and maybe another factor you may think about is the immigration policy. I'd like to
Well, I agree that there could be a trade-off between putting women in the workforce and kids, but not necessarily. So one has to look at those countries in the world that have managed that trade-off well. So I think childcare is definitely sine qua non for that. I think you're right about the education, but I think the education also feeds into the income distribution question. Yes, it's a question of export sector versus tradables, but also, your future income depends a lot on how much tutoring you've gotten, what high school you went to, et cetera, et cetera. So I think education reform would be a good thing for more than this reason. I think it would also be useful for the distribution reason. So one has to look around and see which countries have managed these types of issues. And unfortunately, Scandinavia is sort of small and somewhat different. But there are a number of countries there that have managed to maintain their growth rate, have more females in the labor force, and done better on distribution. So, not impossible. Immigration, yeah. I mean, hard to see that as being the solution, but particularly in the non-tradables, I don't think. But I think your points are well taken.
Sort of to build. Oh, sorry. Yes.
I didn't mean to interrupt you. I guess I'm troubled by what Danny says, mainly because I'm right very often. And when I take the long term for granted in Korea, technological advances and number of world-class companies. And I have to tell you, Danny, for 15 years, I have similar problems. I'm not as comfortable with the near term. There's something, talk about this globalization and market integration, and I take all that message. And there's something quite out of whack. The method that banks pump up their external exposure. Huge net open position. Whenever you get financial difficulties, they're going to be reactive. And in fact, I actually say that we are going through a lane. The years 2008, banks aren't as extended as all created dollars and Korea with 200 bank external assets, a liability of 200 billion, external assets of 180. This makes them vulnerable to anything.
I think I'd like to actually address both of your points. On the long term, you seem very comfortable, less so in the short term, and obviously.
No, I actually, Danny gives us a warning of the long term, which I've always taken for granted. That's unsettling because I throw my concern. The near term is not a great picture.
Regarding the domestic banks, it's two things to point out. If you look at the total size of the banking system, and in terms of how much of it is wholesale financing from abroad, it's not a very large number. I seem to recall wholesale financing is 25% of banking liabilities in Korea. Of that, foreign is less than 10%. But I would have to get back to you on the exact number. But some of the number 6% sticks to my mind. But I have my countries slightly mixed up. In terms of banks, by regulation, cannot have large open positions. So the foreign assets are matched, foreign liabilities are matched by foreign assets. Agreed, they are lending in foreign exchange to domestic counterparts, but there are restrictions on who they can lend to, and it has to be those who are in some sense naturally hedged. So I think we have to be really careful talking about it, because one of the other things I feel often in the debate, especially about Korea, is people look back all the way to 1997 and say, oh, this looks exactly like 1997. But it's not like 97. As I said, it's not even like 2008. If you look at the short-term external debt it's 150 billion. Just do a simple metric. And reserves are more than 300 billion. So, if you talk about reserve coverage of short-term debt, it seems fairly adequate. And we saw that in 2008, that even when the rollovers got tough, with the use of foreign exchange reserves and use of some amount from the Fed swap line, there was liquidity available to the banking system. And as I mentioned earlier, wholesale financing has gone down. Loan to deposit ratios have fallen below 100%, so the vulnerabilities are lower. I mean, if you ask me, if you really, I mean, we don't know the future. If you put me in the spot and said, okay, if we get a Lehman style thing, would it mean that Korean banks will get into trouble? My answer would be no, they would not. For all these reasons, including their risk management practices, which have changed, the new regulations, and the foreign exchange reserves available. The other question, I don't have the numbers here in terms of, as a nation, Korea is, I think, modestly a net creditor country. Slightly, the liabilities are about 400 billion, assets is just a shade above that. So, in terms of national balance sheets as well.
Well, okay, that's true. I wouldn't argue that, but that's not how crises form. You can have that net creditor position and still have crisis. So that's sort of an issue. But are you in favor of this levy on the banks and the IMF? Supporting this levy on the banks that are borrowing?
Look, there are a number of reasons why foreign borrowing and lending is attractive in Korea, and so the levy is relatively low. It doesn't hurt, but we don't think that it'll be that effective, frankly, at the rates, because as long as you have an interest rate differential and exchange rate differential that is fairly large, 10 or 20 basis points is not going to remove the attractiveness of that arbitrage. So, yeah, I mean, the levy is fine, maybe as a setting up as a framework, and it can be adjusted, but you don't want to adjust it too frequently and create uncertainty either in the environment. But it's not, at the level where it would be distortionary or harmful or start looking like a severe capital restriction. But, what really the compelling bet of, in normal times at least, seems to be for other macroeconomic reasons, So, do we think it will be very effective? No. But on the other hand, it's as a framework to have it in place is fine, but it's not going to, and at least as far as we can tell from more recent data, it is not really going to affect in a major way the short-term finance.
I'm wondering what you can tell us about the mechanisms that are put in place striking the extent to which this worry is popped up, and I'm wondering what is underlying.
If you look at the wholesale financing of banks, the foreign part, the foreign component of short-term external debt from banks, half of that is with European banks, and maybe 25% more with the US banks, and then the rest of the world is the remaining 25%. So there is a large exposure to the whole of Europe. Now, direct exposure to Greece, for instance, is minuscule. It's less than $1 billion. And to the southern European countries, it's actually quite small. So where do the concerns come from? I think for that we have to go back to 2008. If there is a generalized global liquidity squeeze, then banks need to And there are a lot of foreign bank branches in Korea. And the foreign bank branches are in this business of borrowing from headquarters and on lending. And that's about half of the short-term debt. So clearly the question is, if your headquarters needs liquidity, as I said, you take it out. You might take it out from where you can, not necessarily where you want. Because if headquarters calls and says, okay, you need to pony up some cash, what are you going to do as the local branch manager? That's the vulnerability that people are looking at. That being said, even at the worst of the crisis, if you look at rollover rates, they didn't fall to zero. They fell by 20 or 30% for a very limited period. And if you go through that thought experiment and look at the exposures and look at where rollover rates can fall in case, because on European banks, I should mention, the concern is because obviously there's talk about, I was just watching CNN this morning about French and German banks and now Belgian banks. And so that's what people are thinking, that those are the guys, not the direct exposure to, say, Greek banks. If you have that, then, and if you build in some kind of thought experiment with rollover rates and how much foreign exchange reserves there are, what are the short-term liquid assets that banks have, it's very hard to come up with a doom and gloom scenario for Korean banks, even in a more intensified phase of the crisis, should that happen.
That sort of the government can step in and
Well, there is foreign exchange. They have foreign exchange reserves, and they are there for a reason, right? They are there precisely to provide liquidity when it's needed. So yeah, they've done that before, and they should be prepared to use them again to. I wouldn't call it a bailout, which is a very loaded term. It's and I realize it makes for a very good copy, but what it is a short-term liquidity facility, and every country does that. Provides liquidity when needed to banks. Not just really. The currency might be different.
About a couple of weeks ago, the governor of Bank of Korea came here in KEI and gave us the outlook. And he mentioned that one of the biggest challenges ahead is the household debt problem. And you also mentioned that as well. And I think that is coupled with the housing market situation. You also mentioned that real estate market in Korea never collapsed, even through the 2008-2009 compared to other countries. And actually, right now it's already back to the levels. But the sentiment in Korea, people are not buying the existing, even the new. That's the problem to me, and in May, actually, with this some eurozone crisis, and if there's some external shocks to Korea, there could be a possibility of the collapse of the housing market, and I don't know. What's going to be the prospect of the housing crisis in the future? People are betting on like it's going to go down. Not everybody, but to me, even to me, I'm not buying right now. Even if there's property, so I'd like to hear more about the
I had one nuance. About a month or two before the governor came, we had another Korean official here for a private event. And they were talking about household debt, and they sort of brushed off the issue by saying, listen, if you look deeply at our household debt, most of it is actually amongst the wealthy end of the spectrum, all of whom have the money to take and cover their debts. So we really don't have much household debt at all. So I guess if you comment on if that comment is, or their perception is accurate, and how that plays into it as well. So.
Yeah. Overall on the household debt problem, let me start with Troy's question. It's high by international standards. And yes, there are mitigating factors. We look at the same data they do, and the distribution is important. That being said, that does not mean that people in lower income levels don't have any household debt at all. And in fact, a lot of them borrow from non-bank financial institutions paying higher interest rates. So it does make them vulnerable, especially if interest rates were to rise. So That being said, it's not, it doesn't pose, in our view, an immediate systemic threat, but it's something that has to be addressed over the medium term. Let me link that back to your question, which is, it is linked, in our view, quite intricately with the housing market. And maybe I can just walk through the channels in a little bit more detail. Well, what you have is most of the mortgages in Korea are floating rate, as you know, and they're 3 to 4 years with bullet. So, when we look at it, in the US we talk about the low loan to value ratios, and people pay nothing or next to nothing, 5 or 10%. But over the life of the loan here, the borrowers tend to build capital and repay the loan, and so over 30 years they own the house, more or less. You could have another scenario where you start at a high level where you put 40% down, and that's great, right, compared to 5%, because you say you're more skin in the game and the banks are protected. But what if you never ever actually go from 40 to 100? You stay at 40 because you keep rolling over the loan, bigger and bigger loans each time. So yeah, you put in some more money, but you extract more equity. We think, in some sense, that's what's happening in Korea, and that's why you're seeing housing indebtedness rise. So you know that house prices will go up in 3 or 4 years. So you put down a little bit more, but you get, you put down $4, you get another 6 in borrowing, and that adds up, over time. So that's the link between house prices and indebtedness in abroad. And how the money is spent, of course, it's mainly education for the kids, and so it's linked to all these other things. It's, consumption as well. I mean, Korea's savings rates are lower than the United States, which is quite a remarkable fact. And so then you talked about transactions volumes drying up now, but I mean, I don't know what will happen. If I could, I would be in a different job making lots of money. Certainly cannot predict the future. But let's look at the past. What has happened every time transactions volumes have started drying up and people like you have said, oh, I think this thing is going to go down? If you look at, we've had 2 housing mini cycles, booms and busts, since 2008 alone. Because whenever transactions volume dries up, there are changes in regulations, DTIs, LTVs, buying of empty apartments by Korea Land and Housing, support to construction sector. Things happen that in effect, even if that's not to support confidence, perhaps, but the net result, and as economists we look at what is the outcome rather than what the motive is, that house prices tend not to fall, and they might go to zero, they might go slightly below, but then they keep rising again, right? So that's been the how the housing policy mix has worked in the past. So I can only look at the past, and as in mutual funds, the past performance is not guide to future performance either. But that's all I can say on that. So we'll wait and see what happens.
Yeah, but when we think about this housing market, we also need to consider the demographic change.
Yes.
I don't know how long you actually get that very well on how the housing market is equity. How long can that with this changes? People think differently. They have experienced that the housing market prices never goes down. And that's what the buying a house is what they are building up. I don't know.
Look, the thing is that it's a chicken and egg problem. If house prices were to fall, say because of normal demand and supply conditions in the market, that would affect indebtedness, that would affect the equity, that would affect people's immediate debt service and consumption, because the equity value of the assets is going down. So, and it would have a macroeconomic impact pretty quickly. So you kind of want to avoid that. So there's a strong incentive to make sure house prices don't fall because of the macroeconomic. It goes beyond confidence. There are real financial channels why it would happen, and we've seen that in the US as well, right? That if house prices fall, it does affect consumption and savings and how much people are willing to spend. So in the short term, it seems, well, that's not a good idea. But once you add up all the short terms, you end up in the long term, and you can end up with a divergence between prices. Now, we don't really have a ready-made solution. How do you allow the market to respond to demographic shifts in family structure and the kinds of houses and what house prices should be doing if populations fall, without the cost of that in terms of macroeconomic, the macroeconomic performance and in terms of production. There's no easy solution. I'd like to say, well, just fix this, and it's like exchange rates. When they are fixed, you can't just say, okay, why don't you float it from tomorrow and everything will be fine. No, because balance sheets are tied to these exchange rates. So, it needs more thought and a more longer time frame in which to implement a policy where you can actually not have the fear of floating the same way.
I know both you're economists, but as political scientists, I'm wondering, are there any political risks that are non-economic related? I mean, you mentioned geopolitics, North Korea, South Korea has always lived under these threats. But are there, for example, domestic political issues that you might see that might change your calculations about your projection in the future? For example, next year's an election. A lot of different areas in Korea. We've been seeing growing trends among South Korean politicians to focus away more toward promoting social welfare and spending more on people's livelihoods and making them comfortable and so forth. I'm wondering if maybe some of these trends is concerning, could be a potential uncertainty in the future where the government is be less less focused on economic growth, but more on general social welfare, which may have growth.
Well, I think you're right. The trend, I think, whether it's because of declining distribution, but I mean, if there are discussions about making education free, or in the future spending more on healthcare, then obviously will be fiscal drains that will probably affect growth. I think the worsening income distribution is always a problem because I think it makes the political economy complicated. You can't probably do exactly what you want to do because of pressures. So, yes, I think politics will play a role, and to the extent that politicians are more inclined to give the public what they want, there can be some issues. The other big question, really, though, related to the demographics is who you spend on. So, if you think about it, you spend it on healthcare, it's for the elderly. You spend it on education, it's for the young. So, there is some intergenerational question which has to be looked at by Korea itself, which it will spend on what. Like in a lot of OECD countries, the demographic group that I'm in is going to be sucking a lot of resources from the younger generation. So that will have an impact on growth as well as social.
Well, I'm not really an expert in political science, so I think I should avoid saying too much, partly also because I work for the IMF.
So you'll be quoted in the Korean paper tomorrow.
Exactly. I'll be quoted in the local paper and be applying for a job at KEI after that. I think just a couple of more general points is one is on inequality. Obviously, it's not something limited to Korea. We've seen that worldwide. In fact, in Korea, the inequality data have actually stabilized a little bit in the last couple of years. But and a lot, at least if I may, allow myself, based on some work I did earlier, it seems a lot of it has to do with technological change rather than anything else. Because we're not seeing the famous business U curve of declining inequality as incomes rise because the technological shock pretty much outweighs everything else. But that being said, obviously, there has to be, social choice has to reflect how much are people willing to, live with. And there are things that can be done within that. And, Danny spoke about education. I spoke a little bit about non-tradable sector. Those are all things that can alleviate these pressures. So there is things, policymakers of any stripe can do things within macroeconomic policy to alleviate that. And I think not just in Korea, but elsewhere. And Korea's social safety net is, by OECD standards, not terribly generous, and I think that also reflects the size of government is quite small in terms of revenue to GDP, and also in terms of payments for that will accrue from the pension plan and from social security and healthcare are quite small. But those reflect social choices. And those have been there for a long time. It doesn't reflect this administration or the previous one. But that's the way it is, and obviously. That's something that, as Danny said, if people want different social choices, they will probably feed into the mechanism. But as things stand, and part of the reason, at least our reading is that the safety net is quite limited, and so it doesn't have, it doesn't need to pose that big a burden as we are seeing in other countries that are rapidly aging. But only because the payments are not that generous to be. And also, we should remember that old age poverty is actually very high in Korea.
Just one last point. What I was struck by last time I was in Korea was the unhappiness index. Right? So despite all outward signs of success, even though the distribution it's not as bad as the U.S., there seems to be a great deal of unhappiness. So I think it goes beyond both economics and political science, more into sociology. What is it that is driving the lack of contentment, despite all the things? Or is that unhappiness fixable with social spending, or is it require some other policy? You try to answer this question.
Yes. Thank you so much. Good insight. And actually, I've been hearing a lot of news about the unhappiness in Korea and how it's related to, some way related to the tempered habitation, the large populations, increased domination over the region, and also the competition with small mom and pop and shop that are that employ a lot of small middle families in Korea. And point out your PowerPoint presentation about how to increase productivity of the in the service sector. You mentioned that opening up the more competition is one solution to this problem. My question is, in a way, the South Korean manufacturing grew because of kind of some of these protectionist measures to protect its industries first, and then open up so there are a certain level of capability of giving forward this. But right now, the service sector in Korea, in my view, is not up to that level. How would you measure their success, their service sector's success, when they're open up for competition? And would that be a good solution to this problem of low productivity, especially after they're getting dominated by large corporations and small medium enterprises relatively suffering this great.
It's really your area.
Well, I take your point, which is that if you take the facts, which is low productivity in services, mom and pops under stress,
then opening it up to foreign competition is not going to hurt mom and pop. When you talk about bringing in Walmart, which would improve productivity in the retail sector. So I think you're right to point that out. So the question is, what other interventions are there other than immediate opening? Well, the Walmart is one thing. The other thing is opening the competition in the insurance sector, or something that is not just strictly for domestic use. So that I think most people would agree with. So I haven't looked at this, but if the cost of insurance in Korea is twice what it is in a neighboring country, well, then opening up to foreign competition would be a good thing. And some of the guys who are holding market share are big boys. So basically you have to reduce their rents. That would help. But in the small sector that you're describing, I think opening it up immediately is not probably the best answer. The question is, what is keeping productivity so low in the SMEs, smaller? And I haven't done work lately in Korea, so I can't tell you what the right set of interventions is. But I take your point that opening up to that sector, to the small retail sector, would probably worsen happiness. So you're right.
Yeah, I mean, it's not easy, and doesn't, again, one of those things, there's no quick fix, and I would agree with that. That being said, there are large segments of the non-tradable sector, which is the services sector employs about 88% of people in Korea, and you can think of areas where you could bring in improved productivity and enhance competition, and that would help. I mean, the question is, and obviously some of these things have social consequences, and one has to think of appropriate fiscal policy and other policies to deal with at least with the transition and the burdens it will impose on particular groups and societies. Part of the reason why you have a lot of mom and pop stores, for example, and other micro enterprises is because of the retirement age, where people retire relatively soon and then they still have to support themselves. So if it's part of a comprehensive package where people work longer, then they won't be there trying to make a living by opening a store and things, and there would be room to improve productivity there and provide employment to these groups of people. So you have to look at it in totality rather than, because of course if you pick any one thing, then we can always think of reasons not to do something, but the problem is that not doing anything would actually not help Korea in the long term in terms of potential growth. Yeah, sure.
First of all, back from the U.S. Chamber of Commerce, I was wondering, with Korea's increasingly robust trade agenda and their FTAs with lots of countries, actually sign one like every 3 months or so, how has that affected, some of these criteria that you're looking at for stability and growth, and some of the other discussions that we've had about how it would affect the households? Have you seen the trade agreements actually have a household level effect?
To be honest, we haven't really looked at it. I mean, we look at it from a macro view, which is, obviously trade is a big driver of growth in Korea, but Korea's trading and export power is not just built on having free trade agreements. Korea's moved up the value chain. It's been very dynamic in that sense, and also the brand equity of Korean corporations has risen. So yeah, trade agreements help. Increase that, and we are suggesting that you need 2 engines of growth. You don't need just one. So that doesn't mean that you should not do free trade agreements or make sure that the export sector is still robust and resilient and dynamic, but you need to do something else on top of that as well. So the free trade agreements are fine, and they'll be helpful, but it's equally important to make progress on the non-tradable sector to make sure it becomes a significant growth. Yes.
was wondering if some people used to say it's too sensitive, but now then again, some people also feel like it's to make the to so it's wondering if everybody in us also about that, the US is having time out that funds.
On reserves obviously serve the function of being there for a rainy day, especially for an economy which can be subject to shocks. And when you have a banking system integrated with the rest of the world and there are requirements on liquidity, reserves do provide a buffer. The question is then how much of a buffer do you need? Is 303 billion the right number? Is 1 trillion the right number? In our view, the reserves that Korea has right now are sufficient to deal with shocks of most kinds that might affect the economy and the financial system. And they are there precisely for times like these. On intervention, the policy is, of course, not to target any level of the exchange rate, but to prevent excessive volatility. What you are seeing, for example, at least news reports, we don't see anything or have any data that you don't see. Clearly, there's been selling of foreign exchange lately to smooth volatility. So it's on both sides, and then smoothing of excessive volatility is appropriate because otherwise large movements very quickly can be destabilizing and it can also have a bad effect on sentiment. We have made that point that the exchange rate, based on our models, and everybody has their own model, and you can argue about the models, whether it is undervalued and by how much. So, yeah, obviously our recommendation would be, as I said, that the exchange rate, should, as the policy is, move in line with fundamentals. Of course, the equilibrium value that you come up with doesn't mean the market value will go anywhere close to equilibrium overnight, but we see that happening over the medium term, and we think that will be actually good for the economy to do that. But even the major currencies can deviate from their long-term equilibrium for long periods of time, and doesn't have to be because of intervention. The euro dollar or the euro yen or the dollar yen rates can move around because these are theoretical constructs. That being said, we think the exchange rate should be allowed to reflect market forces, and there's room for perhaps in normal times less smoothing, if you like. But and you have to also look in context. The Korean won did appreciate after the crisis. It depreciated, but then it appreciated quite a lot in 2009 as well. So if you take the long view, it's hard to make a clear-cut case that there is a deliberate attempt to keep the exchange rate undervalued. I wouldn't make that case.
Right. Well, thank you. I think we've had a very interesting discussion. I think there's a couple of things we can take away from this, which is that in the short term it looks like things for Korea are potentially going well, but that as Danny said, Korea has a long-term choice of do they want to have a 2.5% growth rate or a 5% growth rate. It's sort of tied into something I thought Subir said, which is that a short term plus a short term plus a short term eventually equals a long term. So the choices they start making now will very much impact how things go over the long run. And if you will take and now join me in thanking Danny and Subir for a very interesting discussion. Thank you.
Thanks for the invitation.
Thank you. Good night.
When did you leave around?
Rationally.
You're already twice, I guess.
In terms of the dollar, the yen, I don't know, but a lot of times